How does position sizing work when selling options? Have you ever wondered how traders manage their risk when selling options? Understanding position sizing is key to navigating this complex landscape. Position sizing involves determining how much capital to allocate to each trade, balancing potential rewards with the risks involved. When selling options, the first step is to decide how much of your total trading capital you are willing to risk on a single trade. A common approach is to risk a fixed percentage of your portfolio, typically between 1% and 3%. For instance, if your portfolio is $50,000 and you choose to risk 2%, your maximum loss per trade would be $1,000. Next, you need to calculate the risk associated with each option contract you plan to sell. This risk is influenced by factors such as the strike price, the premium you receive, and the potential maximum loss if the option moves against you. For example, if you sell a naked put option, your risk is calculated as the strike price minus the premium received, multiplied by the number of contracts you are selling. Now that you know your risk per contract, you can determine how many contracts to sell without exceeding your predetermined risk limit. There are several techniques for position sizing. One popular method is the fixed percentage approach, where you allocate a set percentage of your total capital to each trade. As your account value changes, you adjust the number of contracts accordingly. Another method is the fixed risk per trade approach. Here, you calculate the maximum loss you are willing to accept and size your position so that if the trade moves against you, your loss does not exceed that amount. It is also important to consider market volatility. In times of high volatility, you may want to reduce your position size to manage risk effectively. This helps to ensure that you do not take on too much exposure in a turbulent market. Proper position sizing is essential for avoiding large losses and making rational trading decisions. It supports consistent returns over time, especially when selling options, where potential losses can be substantial if the market moves sharply against your position. In practice, a trader selling options will first set a risk limit for each trade. Then, they will calculate the risk per contract based on the characteristics of the option. Finally, they will determine how many contracts to sell to keep the total risk within their comfort zone. This disciplined approach to position sizing is vital for successful options trading and effective risk management.